Of course, Solus Alternative Asset Management Chief Strategist here at Post 9 on this afternoon. It's good to have you, Dan. Welcome.
Thank you, sir.
You know, for all the talk about seasonality and September being fraught, it's not looking too bad.
No, not at all. We keep making not dramatic new highs. We're up only 20 basis points right now. But, you know, like I like to say, my mom, 20 basis points is 20 basis points, and she'll take it.
What do you think's driving it? Is it about a dovish Fed? Is it about an AI trade? Is it about, you know, fiscal tailwinds coming in the next year?
I think there's enough going on that everyone can impart their own views. I know a lot of people are talking about this is a risk-on rally because the Fed's about to cut rates. Okay, but let's not pretend that the story hasn't changed a little bit here about why they're reducing interest rates. And you've also seen a broadening out of the trade. We've talked about this on the network before. You have United Rentals performing exceedingly well, a bunch of consumer names, Expedia, O'Reilly, AutoZone, et cetera. So it's not just AI that's going, not that it was ever just AI, but you do have a lot of other names going on here. And it's conference season. There's the financial services, Barclays Financial Services Conference today. All the banks say the consumer's doing well. There was the Goldman Retailing Conference. Tariffs haven't really come into place yet, but thus far the consumer's doing well. So the narrative coming out of all these conferences has been, on balance, pretty good as well. So I think it's a little bit of everything.
Right. I think, to your point about financials, the presentations today, Blackstone talking about investment booms, consumers still spending at Citi. Really only Jamie was the one who suggested maybe there's some weakening going on.
Yeah, and that's Jamie has...
That's Jamie being Jamie?
Not to, I don't want to... Yes. I see him on the street every once in a while. So,
right.
But, you know, that's Jamie sometimes, yes. And understandably so. But, I mean, listen, we all listen to hundreds of conference calls, read lots of transcripts, read lots of earnings reports. To your point, things are still pretty good. Now, again, there's some stuff to worry about. I've been a little less bullish over the last couple of weeks. I don't think all the impact of tariff has been felt yet. Companies have told us over the next 9 months they're going to come into play. And you have the switch in the jobs market right now, which I think somewhat complicates the picture as well. But to the point, reiterate right now, and on the AI story, good to go.
Right. On the job growth revisions, big debate today about the birth-death model and just how bad the quality is of our data. Do you think, as the Fed tries to look through short-term tariff inflation, that it will get dicey? This notion that maybe this could be worse or longer lasting than we think?
Well, yeah. One of my main talking points these days has been a lot of us come on this network and speak authoritatively about what's going on. And without putting it bluntly, nobody knows what's going on. You've got such a unique cross-current of policy right now, particularly everyone knows about what's going on with immigration. What effect is that having on the Hispanic consumer? We've heard from a number of companies that they've seen some weakness. You also have, obviously, the tariff story. What effect is that having and going to have? And then, of course, you have just the general tone of the market, which on balance we've discussed has been pretty good. So I don't think we have a firm handle on what's going on. On balance, still pretty good. But with respect to the Federal Reserve, the jobs numbers have certainly pushed them into a position where reducing interest rates, the balance of risks favors lowering interest rates. The question you have to wrestle with now is how long are they going to do it for? How much is needed, quote unquote.
Right. I'm trying to think of, I think it was probably B of A in the last couple of days saying it's not unlike most cutting cycles, they might go in September with a cut and then skip October, which is not usually how cutting cycles go.
Yeah. Well, I think the other thing is about historic cutting cycles, and this plays into how market participants should view this, is the Fed, when the Fed starts, ironically, when the Fed starts cutting, that's usually the top of the market-ish. Everyone always talks about, I've heard more times than I can count, the Fed never cuts rates with stocks at an all-time high. That's not really true at all. In 2007, they were cutting. The S&P 500 was basically at an all-time high. What you're trying to do is arrest whatever emergent weakness is appearing. You're trying to arrest that from from metastasizing throughout the economy. Quite often it doesn't work, but that's what the goal is. But this is not that, at least not yet. We don't have data that supports that as of yet. This is, I think we need, quote unquote, I think we need to just tweak things a little bit to hope to make sure that things that are clearly slowing down don't slow down more. And I think that probably entails getting the Fed funds rate from 4.5% to call it 3.5%. And then again, the question for viewers at home and for investors is, what do you do with that?
Right.